Thank you everyone for joining us today for today's Murphy Mini. Last time we talked about HSAs, and this time we're going to kind of round out that account discussion with FSAs, HRAs, and LSAs. And of course, we had to be funny with it. So, oh my, say it over and over and over again while you skip down the yellow brick road. We will be recording this. We will provide the materials afterwards. And then I think we'll actually have time to answer questions at the end. I don't think we have to answer a lot of them during it, unless Claire or I see one that we think would be good to answer during it. But with the number of slides, I think we should have enough time for questions at the end. So please send in your questions using that Q&A function. As you know, if we don't have time to get to it, follow up with your Holmes Murphy team. They know how to get in touch with us. We will answer your questions. Here's the speakers. I keep on asking Lisa for her headshot that she got professionally done with Holmes Murphy, and she refuses to provide it to me. She's not happy.
I don't have it. They didn't send it to me.
Yeah, it's out on SharePoint on the shared drive.
I'll find it. Then we're going to get her in there. Lisa's joining us, and then of course we have our disclaimer. If you've been through this presentation before, you're probably tired of hearing me talk about it, but I'm going to say it every single time. What we're talking about today is not meant to be taken as legal or tax advice. If you need legal advice or tax advice, we highly recommend that you talk to your legal counsel or your tax advisor. Luckily, as we're talking about FSAs, HRAs, and LSAs, that shouldn't be as pertinent, right? These are pretty straightforward rules. And for some of you, you're probably wondering, how the heck are we going to do a presentation on this? What we're trying to focus on in this one is some of the common things that we're dealing with when we're talking about FSAs, HRAs, and LSAs, providing a little bit of background, but really just getting into some of those nuances, targeting the questions that we get from you guys and from our teammates here at Holmes Murphy. So let's start with health FSAs. We're not going to talk about DCAPs today. Did not have enough time to put that in here. A DCAP, of course, being that dependent care FSA. We're setting that one aside. We're just going to focus on the health FSA for today's presentation. One of the things that we want to say right off the bat is that it is a self-insured group health plan. Interestingly enough, because so many of you are so hands-off with your FSAs, you don't think of it as being a self-insured group health plan, but ultimately it is. You're paying for claims out of your general assets. And as a result, it's going to come with a lot of the compliance obligations that we would expect for a major medical self-insured plan. For those of you that are subject to ERISA, you're going to have ERISA plan documents. HIPAA privacy and security compliance will apply. COBRA in certain situations will apply. This is the only time I'm going to talk about COBRA when we're talking about the health FSAs, and it'll be a brief mention for HRAs as well. I was trying to put that into this presentation, and it's too much. Talking about overspent and underspent accounts and stuff like that. We have a great XyWave article that we can provide you if you want more information. For a lot of your plan participants out there, COBRA won't actually be applicable because they've overspent their FSA account, meaning the amount that they could get out of their FSA is less than they would have to pay for it, is the easiest way to put it. So all of these things will apply, as well as section 105 non-discrimination rules. With the HIPAA privacy and security, one of the things that we'll often hear from our clients when, let's say, they have a fully insured plan and then they have a health FSA, is they're like, we never see any of this. Like, we don't touch this at all. We have no role in the administration. The thing is, at any time, you could take over administration of that health FSA and bring it in-house. You could, fire further task, whoever it is, and say, we're doing this ourselves. And you'd have the right to do it. It's your own self-insured plan. No one really does that. Although what's interesting is when I first started this industry over a decade ago now, I would say a quarter of the clients I worked with did their FSA in-house. It was still somewhat common to see that. Now, Claire, are you aware of any of our clients that do their FSA in-house anymore? Yeah, the cost of administration has gone down. And most of you would look at it and say, why would I want to do that? It sounds like a lot of work, and I'd agree with you.
It totally is. I can't think of, I think maybe there was still one person when I first came to Holmes Murphy like 12 years ago, but I mean, one client, but other than that, I haven't seen it in forever. It's also uncomfortable, if you're denying something that your employee puts through, why not let a vendor handle that for sure?
Exactly. And then it's going to be funded with employee and employer contributions. For a lot of you, you're just having employee contributions, but every once in a while, some of you will contribute to the health FSA. Usually, you're going to want to cap that FSA contribution at $500. In order for an FSA to be an accepted benefit under the HIPAA portability rules and the Affordable Care Act, Either you're capping the contributions, the employer contributions at $500 or no more than 2 times their FSA election. That gets confusing, that 2 times the FSA election, to make sure that you're within that accepted benefit rule. So usually we're saying, all right, we're just going to cap our FSA contribution at $500. Otherwise, everything else is employee contributions.
Okay, so do we want to talk for 1 second about
Mhm.
why it's important to remain an accepted benefit?
That would be a good idea, right?
Really quickly. If this is an accepted benefit, you have a limited COBRA offer obligation, which I think, because otherwise, if it's not an accepted benefit, you have to continue offering COBRA for the FSA to this individual for the life of the time period that they're on COBRA. And I think most people, if they're going to offer it, they would much rather offer it for that brief period of time, the first election period that the employee has.
That's a really good point. Another reason is also just because under the Affordable Care Act, a non-accepted benefit FSA will generally never comply with the Affordable Care Act. It's by nature going to be a non-compliant group health plan. So because of the Affordable Care Act, we almost always want these to be accepted benefits. Yeah, I won't get into the mud as far as treating like an HRA and having it integrated with the employer's plan. We'll set that aside. You just want it to be an accepted benefit. It's going to reimburse eligible 213D medical expenses. Interestingly enough, employers have the ability to exclude coverage for chosen medical expenses. So if you have a health FSA and you don't want to cover certain 213D medical expenses, let's say you don't want to allow for coverage for the over-the-counter stuff, like the Band-Aids and all that. I don't know why you would do that, but let's say you've had issues in the past, whatever, and you want to exclude that. You can do that because it is your self-insured health plan. You have the ability to pick and choose. That's also how you set up a limited purpose health FSA, right? If you want to do a limited purpose health FSA, you're going to say we're not going to cover things beyond some preventive and then dental and vision or whatever it is. Oh, I thought you had something to say there, Claire. It can also reimburse the medical expenses of spouses and dependents, including adult dependents up through age 26. And that is one of the differences between the FSA and the HSA. Remember, the HSAs, it had to be tax dependents, whereas an FSA, it can be for adult dependents up through age 26. We actually just had a conversation with an employee a little while ago where they're running to that issue. They're like, oh, my adult dependent that's on the plan is going to have some medical expenses coming up. I'm doing the HSA right now. I need to switch over to the FSA at the next open enrollment, don't I? And it's like, yes, you do. If you want to be able to use it for that dependent, if you want to use flex dollars, you want to go over to the FSA. And then we have annual plan year contribution limits. In 2024, it is $3,200. And the limit applies on an employer by employer basis. If I moonlight for a company and they offer me a health FSA, and that company isn't part of a control group with Holmes Murphy, I can do $3,200 at Holmes Murphy, and I can do $3,200 at that other employer. There is no limit on how many different FSAs the individual has. The limit is actually on an employer by employer basis. So I can't have more than one with Holmes Murphy or any of its affiliates. Generally, employees are going to be locked into the contribution election unless they have a status change event that's recognized by the employer. It has to be recognized by the rules, but also be recognized by the employer. And you'll want to have this outlined in your cafeteria plan document and probably also in your health FSA SPD. We do have clients that will change or kind of tweak what they recognize as a status change for the health FSA to avoid situations where someone says they've spent all of their money, they've spent their $3,200, but they haven't fully contributed to their health FSA. That's all right. I've had this event. Now I want to cease my my participation in the health FSA. You can design around that. There are other design options like that. So just remember, if there's something that's consistently kind of been a headache for you with the health FSA, contact your Holmes Murphy team. They'll talk to us and we'll see if there's a way to design around it through your Section 125 document and your health FSA SPD. Yes, Claire.
Okay, one thing I wanted to add here is that when we say annual plan year contribution, the IRS is referring to a calendar year plan year. So if you have a mid-year plan that maybe starts July 1st, you're not going to be able to switch to the contribution limit until much later in the year.
Yep. So if for 2024, you would have that, 3,200 for 2024 starting July 1st. And then it wouldn't be until July 1st of 2025 that you'd go up to 2025's contribution limit. And then carryovers and grace periods do not impact those contribution limits. And we'll talk about grace periods and carryovers in a second here.
So we had a quick question about whether or not the FSA can be used for someone who is your dependent, but not on your insurance plan.
Absolutely. Yep, you can, if it's an adult dependent, you can use it for that individual, even if they aren't covered by your major medical plan. There's no requirement there. The uniform coverage rule requires that the full amount of the employee's election be made available as of the start of the plan year. This is how it makes your health FSA essentially operate like insurance, which then makes it excludable from taxable income under sections 105 and 106. So the idea is it's kind of a give and take. The government said they have this, we'll talk about forfeitures, the employee has the risk of loss if they don't use it. However, the employer, if an employee on January 2nd uses their full election, and then they leave employment with you later that month, you can't take out the full amount from their final paycheck or anything like that. You're basically out the money. They've used it like that insurance. So you have to make the full amount available from the start of the plan year. On the flip side, if they don't use all of their funds by the end of the plan year, whether there's a carryover grace period, whatever, they forfeit those funds. We get a lot of questions about what to do with forfeitures. It's not an easy conversation. When we're trying to, get a little crafty with it, the easiest way to handle it is to just use the funds to defray plan expenses, because that'll comply with both the IRS and their guidance, as well as for those of you that are subject to ERISA, the ERISA requirements, where you're not having any of the funds revert back to the employer for use for anything or whatever. The IRS would say that's okay. So for public employers, that might actually be okay. But the DOL, and ERISA, they're saying no. You're going to want to use it for the benefit of the plan. Sometimes people say, well, can we do contributions to people's health FSAs? That might be an option as well. But I would say normally take those forfeitures and put them against your plan expenses. Again, employee contributions that aren't used by the end of the plan year are going to be forfeited. That's the use or lose rule. And you have the choice of either offering your employees a grace period or a carryover, or neither. I should put in here or neither, because you don't have to offer a grace period or carryover. It's your choice to do so. But whichever option you go with, if you do go with one of those options, it should be reflected in your applicable plan documents, whether it's an ERISA SPD or the Section 125 or both. And real quick about the carryovers, it allows for the unused funds to be carried over into the new plan year. The carryover limit for 2024 is $640. So that's $640 that will be carried over into the 2025 plan year from 2024. And it essentially operates like a new election to participate in the health FSA. If someone has funds that carry over into the new plan year, they've kind of had this passive enrollment into the FSA, and they are a plan participant in the FSA once again, even if no new contributions are made. Now, interestingly, Lisa spent a little bit of time, I think it was this week or last week, doing some research about what employers can do to kind of limit those situations where someone just has $10 that year after year carries over and they're not using it. And the IRS has said that there are a couple of options. One is they can say that, and this one is explicit, that an employer can say you only get the carryover if you make a minimum election for yourself of $100, $200, whatever it is. If you don't make that election, then the carryover doesn't exist and you're done at the end of the plan year. The other one that we have informal comments, they're non-binding from the IRS, but it makes sense, is they've also said, or you could just set a de minimis amount, a minimum that needs to be in the account in order for it to carry over. So at least $50 or $100 or something like that needs to be in the account in order for you to carry it over into the new plan year. If it's only $5 or anything less than that stated amount, then you do not become a plan participant in the new plan year. Yes, Claire. Uh-oh.
Okay, so we had a comment about the use it or lose it rule. One of our clients asked the question, hey, can't we, take whatever is remaining, if the employee is upside down in that FSA, can't we take anything that would be remaining out of the employee's last paycheck?
Generally, you're not able to do that.
Yeah, you're not. And you also have state rules about what is allowed. So, I mean, you can always check with your payroll company, but I just don't think that it's going to work out.
Yep. Well, and one of the big things also is when you look at the section 125 rules, this is the hard part about doing these presentations because there's all these little rabbit holes you can go down, right? When you look at the section 125 rules, you're supposed to have uniform contribution schedules for everyone. So it's supposed to be the same for them throughout the year when they're paying for their benefits or contributing towards their benefits on a pre-tax basis. And so any kind of acceleration would not be uniform with all other plan participants. And so that's why you generally can't do that. So if you don't want to do the carryover, you have the option of doing the grace period, and that allows for up to 2.5 months past the end of the plan year for the individual to incur new expenses. This is different. So, it'd be through March 15th, usually, right, is when we have the cutoff for the grace period. That's different than the run-out period. The run-out period is for submitting expenses that were incurred during the plan year. So for a lot of you, before December 31st. Whereas, and everyone has a run-out, whereas the grace period is going to be 2.5 months to incur new expenses and get them submitted. Sometimes you'll then tack on the run-out to the end of that grace period. How are we doing, Claire? Lisa? Good? All right, so that's health FSAs. Now you're going to see a little redundancy here when we first start talking about health reimbursement arrangements or accounts, whichever you want to call it, HRAs. And then we'll kind of get into how they diverge. So right off the bat, once again, an HRA is a self-insured group health plan. So again, it comes with all the compliance requirements that we were talking about before, ERISA plan documents for those of you subject to ERISA, HIPAA privacy and security, COBRA, Section 105 non-discrimination rules. It's almost the exact same as the health FSA, right? And the HRAs go by so many different names. Medical expense reimbursement plan, or MERP. Was it a year ago now or something like that? We had a few different vendors coming out saying, oh, you got to be implementing a MERP. Everything's about the MERP or whatever. And Claire and I kept on having to have these conversations with the vendor saying a MERP is just an HRA. And of course the vendor would be like, oh, you got us. Like, we were just trying to come up with something new. But you also hear sometimes called partial self-funding, where you're doing an HRA on top of a fully insured plan or whatever. But no matter what, it's an HRA. It's reimbursing medical expenses. And it can also be an unintentional. Whenever we have a client that's like, well, it's not covered by the plan. I get that. They don't have this. Can I just cut them a check to pay for this? That's actually probably setting up an unofficial, an unintentional HRA, which would mean that you're supposed to be complying with all the different compliance requirements that we're talking about right now. So usually if we're going to be reimbursing medical expenses, we want to make sure we're doing it through a properly established HRA.
Now, I was just going to add, you've got lots of issues if you do that. You've got potential discrimination issues. You've got changes that you would need to write into your plan document. There's all kinds of things that would come with it. Look at that, circling HIPAA privacy and security.
That's the biggest one in my book. You are now
it's
aware of someone's medical issue. You are acting on it. It's not within your HIPAA universe. You're working outside of HIPAA, and that's where 2 years you've done something nice for them, and then a year later that person says, I was fired because they knew that I needed that medication. They were paying me for it and they didn't want to pay for it anymore, whatever. It sounds far-fetched. It's the kind of stuff that Claire, Lisa, and myself run into fairly frequently, actually. Here's one of the big differences between the health FSA and the HRA. The HRA is funded solely by the employer. There are no employee contributions to an HRA. It has to be funded solely by the employer. And generally these contributions, they do this, it's going to be an accounting practice. They're saying you have this amount that you can use in your HRA, but in reality, the expenses are just reimbursed directly out of the employer's general assets. So it's unfunded, right? It's an accounting practice saying, this is how much you have available, but we're not actually putting this into your HRA. If the funds are actually put into the HRA, then it becomes funded. It should be going into a trust. And we see this most commonly with our Service Contractor Act employers and the Davis-Bacon ones, where they have to meet certain contribution thresholds. And so they're putting money into the account, actually putting it in there and saying this belongs to the employee now. When they leave, they get to keep it. It's in their HRA. There are no funding limits for HRAs. So before we were talking about the cap on contribution limits for the employee into a health FSA. For an HRA, if you wanted to, is all right, you have $100,000 in each one of your HRAs, right? It's trying to come up with something that's probably no one's doing right now. However, they're probably accounting rules. I'm not going to get into that. I'll leave that to the finance people, but there's probably some things with outstanding liabilities and stuff like that where you probably have some form of limit on how much you can say someone has available to them in an HRA. But for the rules that Claire, Lisa, and myself are concerned with, there is no practical limit. For ACA compliance purposes, and this is another difference, with a health FSA, you could have an employee that just takes the health FSA and you have no idea if they're on your group health plan, or they're not on your group health plan. You don't know if they have another employer's group health plan. That's fine. For an HRA, you will generally want to limit participation in the HRA to employees that are either covered by your group health plan, and that's the easiest, or who can show that they're covered by another employer-sponsored group health plan. And the reason why is because then you can say that HRA is integrated. Claire has given us the nice hint. Integrated. The HRA is integrated with group health plan coverage, and therefore it doesn't have to worry about complying with the Affordable Care Act. If it's not integrated, then it's supposed to be complying with the Affordable Care Act on its own, which no HRA generally can do, because it's not going to cover 100% of preventive health services and some other things like that. So we want it to be integrated with either your group health plan or the group health plan of another employer. These rules generally don't apply to retiree HRAs and HRAs. I'm not going to go too far down those rabbit holes. But if your HRA does not cover any active employees, it's just for retirees, then it doesn't have to be integrated. And then in HRA, I think we can do an entire presentation just on HRA. So that might be something that we're putting on the calendar. Because I'm not going to go into HRAs outside of just knowing that they have kind of their own rules. It's an HRA that can reimburse individuals' premiums. And so they're a little funky, a little strange, and a little outside the scope of this presentation.
And I would say if you've been in this business for a long time and this sounds strange to you, the changes that require the HRA to be integrated with a group health plan are relatively recent. They're, as Nick indicated, Affordable Care Act based, right? And specific regulations had to be written. So, if this sounds different than what you had originally thought of, that's probably why.
When it was a rolling set of regulations, I think we got our first one out on HRAs in 2013, then we got another batch in 2014. And I think it went all the way through like 2017, where they were kind of trying to pin down what an integrated HRA looks like. Again, it's going to reimburse the eligible 213D medical expenses. And again, an employer can pick and choose which expenses it wants to reimburse with that HRA. We see that more with the HRA than we do with the FSA. Since the FSA has employee money in it, you're usually like, all right, employee, use it for whatever you want, as long as it's a 213D medical expense. For the HRA, we'll have very targeted HRAs. We have some clients right now that are contemplating putting in HRAs to help out employees that have very specific drugs, right? So it's like, for these specialty medications, we are going to provide a form of reimbursement under an HRA, and that's the only thing that we're going to reimburse under this HRA. And again, it can reimburse the medical expenses of spouse dependents and adult dependents up through age 26. So again, that's where the HRA and the FSA are different than the HSA. I think I have 5 minutes here. Just a couple more on HRAs and we'll talk about LSAs. But before I get into that, as I'm going through all these acronyms, it always reminds me when I started in this industry over a decade ago, and Cindy Neeson, I asked her, hey, I don't have anything to do right now. What should I do? She said, how about you make a list of all the acronyms and define them? I remember doing that for like 15 minutes and be like, I don't know if I'm in the right industry. Like, I don't know if I should be here. Neither here nor there. HRAs, there is no use or lose rule. So you can have unused funds roll forward as long as you want, or you could say that each year it resets. So you could say each year you have $1,000 available to you, and that's the maximum. Or you could say if you don't use that $1,000, whatever is unused can go over to the next year, or a portion of it, 500 of it can go over to the next year. You're you have a lot of flexibility in designing that. Again, there might be some accounting rules. We'll leave that to the bean counters to figure out what that looks like. And there is no uniform coverage rule. This I don't see as often, but if an employer wanted to do some sort of graduated availability of the HRA, they could do that. So they could say, you have $500 available as of January 1st, and then you have $1,000 available as of July 1st. You could do that as well. Don't see that was actually more common a while ago. I don't know why that's fallen off, but it is an option. Okay, LSAs. I lied. I told us that we're going to have plenty of time for questions at the end. Luckily, I'm not seeing a lot of them, but here we are. LSAs. We threw this one in here because we still get a lot of LSA questions, but one of these things is not like the others, and that is the LSA. There is no tax advantage to the lifestyle spending account. It's essentially a way for an employer, it's a way for you to provide additional compensation, additional taxable cash with a little more control over it. There are very few compliance requirements for an LSA. None of the general compliance things that we work with, all the great acronyms I was just talking about, ERISA, HIPAA, whatever, they don't apply to LSAs. You're really just looking at tax rules for compensation. One big thing, if you have an LSA, make sure it does not cover any medical expenses or anything that could be considered a medical expense, because if you do, then you're probably creating a non-compliant HRA because you'd be reimbursing non-medical items in the same account that's reimbursing some sort of medical expense. That would be a non-compliant HRA. So you don't want your LSAs to cover any medical expenses. LSAs, you're covering things like gym memberships, exercise programs, educational opportunities, travel, really anything you want to. If you think of it, something that's an employee could spend cash on, you could include it in an LSA.
And I think this is an increasingly popular option for people to offer. It's something new, it's different, and it appeals to people, I think, in the same way that getting a gift card at Christmas kind of appeals to people. You can do what you want to.
Yep. Good question just came in. Would health screenings fall under medical expenses? I generally would say yes, it would. If someone is, I don't see a way that we would exclude. That would be reimbursable under Section 213D. You'd be able to use a health FSA or an HRA for a health screening. So if that's the case, that's a good way, a net way to analyze it. Is this something that I could submit to a health FSA or an HRA and it would be reimbursed? If the answer is yes, then you don't want your LSA to cover it. One of the big benefits is that the employers retain any unused amounts. So if you say every employer has $500 in their LSA and a bunch of them don't use their full 500, then you're not out that additional compensation, right? It's not money out the door. The drawback, and this is one that we have to talk about, is that you're usually paying a fee to a vendor to administer it for you. So you're paying additional money just to provide your employees with taxable compensation. We've had a few clients that have said, that doesn't sound great to me. I would prefer to just pay everyone $500 more than pay $520 potentially, but that $20 being, for it to be administered by a vendor. So it's kind of a balancing act on how much utilization you think you get and the benefit you think you'd get out of it. Well, here's the beautiful thing. Oh, we have one question. This person caught us right before I was about to say, we've done such a good job. We don't have any other questions here. Yep. So one of the questions, you could absolutely just increase compensation instead of doing an LSA. The benefit is if I increase compensation, then once I write that check, that money is gone. Whereas if I say an employee has $500 and they only use $100 of it, then that $400 is still in my pocket. I'm not out having to pay that employee out on any unused amounts. I get to keep it. With the gym membership and stuff like that, usually you'll see it as part of like a wellness plan perk or something like that. And we would normally say, unless it's de minimis, that it is actual taxable benefit to the employee, right? So that is a little separate. Here, we're just talking about employees outside of the plan, just submitting for, hey, I want to go do Pilates class or something like that. having that paid for in Pilates classes, the IRS has been very clear, are not medical expenses. And so that's kind of where we have that divergence. If you have additional questions on when an LSA expense is or is not for medical care, or how that is different, if you have one right now and you're a little bit worried about that, get in touch with your Holmes Murphy representative, and I'm sure we can work that one out. We don't have any other questions. We're 1 minute over, but we're pretty darn close to being right on time. But as you all hear, every single time we do this presentation, this doesn't have to be the end of the conversation. If you have additional questions, please reach out to your Holmes Murphy representative. They know how to get in touch with us. We're nerds. We love talking about this. So we'll talk to you about it as much as you want. But thank you very much, everyone, for joining us.